This is a video on part of the series on featured stocks. The stock is Netflix, and picked Netflix as kind of a representative stock of kind of a high flyer stock. Tesla, Amazon, the handful of companies that really have a strong possibility of sustaining quite high growth for an extended period of time. So when we look at Netflix, the first thing that I see is the price momentum is about even with the market, which is a little unusual. You can see actually today it's up almost 4%, but for the last 3 months for it to be maintained equal with the market, a little concerning because you expect a better performance price movement than the overall market. The cost of capital at 7%. For high-flying stocks, that's really not that meaningful. And as I've talked about in the closer look videos on valuation calculation, that cost of capital is not something that should spend a lot of time on anyway. But I will briefly mention that a high-performing stock like this with a lot of expectations built into the stock price, its price has a tendency to not be correlated with the overall market. Regardless of whether the market goes up or down, these kind of stocks tend to have their own course in terms of going up or going down. It is just not very. So the calculation of a market expected rate of return is not very meaningful. What we notice now is the theoretical price using the defaults is quite a bit lower than the current price. And that's to be expected, even with pretty liberal growth forecast defaulted for growth forecasts. Let's go down here and look at some of the other parameters. Profit margin, pretty healthy profit margin is what we're assuming Netflix will eventually mean revert to. Not many shares being issued to dilute the current shareholders' ownership of earnings. PE ratio. Going from 192 to 12, that's to be expected. Probably want to come back and revisit PE a little bit more. And then the additional parameter is the default number of years that growth is assumed to go on until it mean reverts. And as discussed in previous videos, that's 5 years. So of all those parameters, the two that seem most reasonable to spend some time on as it relates to Netflix is the future PE and the number of years that sales growth is expected to continue. One of them comes to mind is profit margin. I should mention that right now the mean reversion of the profit margin is going to the industry standard. It's got Netflix in the broadcasting and cable TV industry. For these high flyers, you got to question even what industry they're really part of, or will they be part of. Netflix could end up creating its own industry. It's more of a production company than just strictly a broadcasting company. So applying that industry's profit margin to Netflix may not be entirely appropriate. But I'm going to go ahead and go forward since it is such a big improvement of where they are now. We'll just go with 14% until that becomes questionable. But that seems like a very healthy profit margin to expect that Netflix could eventually gravitate to. So the PE ratio, as I've talked about in the past, PE ratio, a normal PE ratio is 15. And PE ratio or multiple mathematically can be thought of as just 1 divided by the future expected rate of return minus any kind of growth that you think the company will be able to maintain after it mean reverts. Netflix with its brand probably will be able to continue to grow at the overall rate of the economy, and that typically is about 2.5%, 3%. So with a PE ratio of below the average of 15, it means that either the rate of return, the certainty of the cash flows are fairly certain, so the expected market expected rate of return is low, or there, like I said, is some continued growth. So let's assume that Netflix PE, the cash flows continue to be maybe a little higher, like something in the neighborhood of maybe an 8%, because 15 PE relates to or corresponds to about a 7.5 market expected rate of return. So we assume that Netflix its cash flows will continue to be a little bit riskier than the overall market. That would bring it in about 8% expected return. But we subtract off the 2.5% rate that we expect it to be able to continue to grow, and you end up with 5.5%. So 1 divided by that, which is essentially the P, gives you a PE ratio closer to 18. So PE ratio might be a little light because it's assuming that there's a total reversion to this industry called broadcasting, but that might be a little light. 18 might be a little too much, but 12 is a little too light. So I'm going to go with 16 versus 12. So let's keep that in mind later on. To refresh your memory, what you do when you have a different assessment about PE is you just take the ratio of what the new assessment is divided by the default assessment, and that would be the incremental increase in valuation. So that's one change we'll make. In fact, let's do the math right now. If we assume a 16 versus the current default is 12.3, that's an increase of about 30% of valuation. Now the other one that's going to be true most times for these kind of high flyer stocks is the length of time that this sales growth would continue. Should be taken up at least to 7 years. So a reminder of how you do that. It's a little more involved, but you take your growth rate divided by 1 plus the share growth, 1 plus the cost of capital to the exponent of 7 minus 5, which is 2. And that's the overall increase in valuation. So let's do that. The growth is 45, so 1 plus 1.45 divided by the cost of capital is 1.07 divided by the share growth, which is 1.014. So that ends up to be about 1.33. And then if you take that to the second power, and it's a whopping almost 1.8 factor. Well, you multiply that by the factor that we got for an increased PE ratio. You go from, again, the PE that we said we were going to go to is more like 16 versus 12.2. So that was like a 30% times or 1.8%. So you're looking at almost well over doubling the valuation. Let's leave it at just a doubling for now. And so when we come up here and we move, so that would take it up to $400. So you just move the sales growth slider to when you see, in the neighborhood of $400. Well, because we are modifying the length of time, we watch the valuation detailed formulas in the closer look folder. You'll know that this value here is not correct, so we need to recalculate it based on the assumptions we're making. And so we take the valuation divided by the price to the 1/7. So the valuation is roughly 400 divided by 340. And then we take that to the 1/7 value, to the 1/7, and then multiply that result by the cost of future cost of capital, which we're assuming can be around 8%. And it says that the investment return is about 10.53%, which is pretty close to what happens to be showing right now with in the practical value. So the last thing we would typically have to do is move this around to lock in, if we were going to lock in at 10.5%, but it's already close to what we just calculated. So with an assumptions of sales growth continuing on for an additional 2 years, for 7 years, and a PE ratio going from 12.3 to 16, we end up with a target investment return of 10.2%. Other things we may want to consider changing, because 10.2% for such a high-flying stock is really not enough to warrant the investment. The risk return is just not there. So the only other thing that can be looked at is maybe thinking about the profit margin, or even I wouldn't do anything with share issue trend. If anything, Netflix will be issuing more shares, not doing less, or even repurchasing shares. So the really only thing left to do would be do something with the profit margin, and that's pretty straightforward. The higher, you just take the ratio of how much higher you think it'll be. But I'm not comfortable right now moving that any higher than 14. So we're left with a 10.2 target investment return, and that's just not enough return for me regarding a company like Netflix with needing to turn in this exorbitant year in and year out sales growth while changing their operations to produce pretty healthy profit margins, and then end up someday mean reverting to a PE ratio in the neighborhood of 16. Just a lot of change there that for that risk of something going wrong, 10.2% target investment return is just not enough to warrant taking on that kind of risk.